Okay, in our last section, we left off pondering the possibility that there's going to be an exchange. The lenders in our example were going to receive some equity, $190,000 in equity, and instead of the original, 500,000 and $200,000 in loans, they're going to exchange all of that for $100,000 in senior debt, and the residual will go to the to equity. And the question that we left off in the last section was, should the subordinated lenders, who would appear to be wiped out, presumably if the senior folks who had an original $500,000 claim were to receive all of the equity, if they were to be wiped out, would they receive any fraction of the equity? What would actually be negotiated? And so we introduced the idea that we have potentially out-of-court restructurings as well as in-court restructuring and restructurings, and that's what we turn our attention to next. So first, let's talk about an out-of-court restructuring. This is voluntary. Terms are negotiated without a judge. This is preferable when you can do it that over a Chapter 11 in-court bankruptcy, because you avoid legal fees and other types of fees which can be significantly large. There are many things that prevent out-of-court restructurings from happening, that sort of force companies to go into an in-court setting, which we'll talk about. But let's talk about the out-of-court restructuring scenario for the moment. So let's assume that in an out-of-court voluntary setting, management proposes to the lenders that the senior lender accept, in exchange for their $500,000, their current $500,000 loan, they replace it with a $100,000 loan and 7,000 shares in common stock, which, if you recall, we had our 120,000 shares originally. So this now equates to 98.3% of the company's equity, and the old 120,000 shareholders still retain 1.7% of the equity. And in such a scenario, notice that the subordinated lenders get nothing. And so let's say, so the question is, why should the equity folks get anything? So let's suppose in this scenario, management determined that who owns significant portions of the equity in our example, determined that if they were further diluted, they could just simply refuse to play ball. They wanted to retain just a little bit of equity. So why? Because of course you could arbitrarily offer 70,000 shares and dilute these guys even further. So I guess the question is, would the senior lender agree to this? Would the senior lender agree to something that looks like it's roughly, they're getting roughly $290,000 in value for something that they originally had $500,000 worth of value in? To which the answer is it's not necessarily clear. They may agree because their loans are currently trading at 50 cents on the dollar. They may or may not agree. This way they're getting, it looks like they'd be getting a little bit better than 50 cents on the dollar. 290 over 500,000 is a little bit better. But the next question is, why would subordinated lenders agree? To which I think everyone would say no, getting nothing in a voluntary exchange like this, when they could, there's no upside for them to do that. So they would probably not agree to a scenario like this. Let's look at the numbers here. So in an exchange that we're contemplating, the lenders would receive equity worth 186.8, while the old equity retained 3.2. That's at 98.3%. That's amounting to that 186.8, and the old equity is still on the books. So the total value recovered by the senior lenders in this scenario would be $286.8 million, roughly 57% recovery. Again, they had an original note of 500,000, so this is 57% recovery. Recovery to the subordinated lenders is zero. And now the question is this business sustainable going forward? Let's say hypothetically you were able to convince subordinated lenders to accept nothing, which you wouldn't in a situation like this, but let's say hypothetically you could. Well, is this business sustainable going forward? Well, the new debt to equity ratio for this company is 53%, depending on the industry and depending on the risk tolerances of everyone involved. That certainly looks like a capital structure that may that may work. So now there are other alternatives. As in most restructurings, this was just one potential alternative. Note that in the example that we just talked about, that debt to equity ratio of 53% was considered acceptable. It may be, you do see some restructurings that are 100% equity at the end. So instead of the senior debt, the senior notes getting anything in new debt, in our example, we contemplated giving them $100,000 in a new note. They could have just as easily proposed that basically the senior lenders just get all equity, so they get $290,000 worth of equity value. So that's that. Let's talk about one more issue here, which is the company does have $200,000 in cash. So let's remember that the company could have actually fully or partially bought out a large fraction of the lender's claims at a discount. So as opposed to doing something like this, it's quite the company could have gone out in the open market, and you've got these notes that are trading at 50 cents on the dollar, and you've got notes trading at 20 cents on the dollar. You could have bought out. You have the market value of all this debt is 290. You could have bought out a substantial portion of that with your $200,000 in debt. So that's another possibility. If you think you can sort of ride out the storm and just take out the existing debt altogether, well, that's certainly something that you could do as well. Now, despite the simplicity and benefits of lower costs, there are disadvantages. Non-financial liabilities like pensions, unfavorable leases and contracts, union contracts, for example, they're often the very cause of distress. They can be far better managed, aka rejected in a bankruptcy. Voluntary cooperation and out-of-court restructuring is also particularly difficult when there are many parties. Just looking back at this, this first bullet. In fact, one of the impetuses for getting into a bankruptcy is for filing for bankruptcy for a lot of companies, like the airlines are a good example, is to shed unfavorable union contracts. So these are benefits that are only afforded through an in-court bankruptcy process as opposed to voluntary out-of-court bankruptcy. Now, this second bullet is also important because one of the issues, we had a very simplified example here where we talked about, two classes of debt. And even with these two folks, you could, I suspect some of you guys had already got a sense of what a potential negotiation between these two folks in reality would look like, where these guys say, no, we're not gonna be fine with 0%. We want 30% recovery, and these guys, and obviously that would come out of their pocket. And so there's negotiation there. But even within individual debt tranches, there are problems in getting everyone together. It's sort of like herding cats. You have holdout problems. You have the reality that lenders are comprised of syndicates, many folks that maybe have different interests. You may be talking about bonds that are owned by various folks that some folks may be willing to exchange, some may not. And so the more complicated the capital structure, the more complicated, the more unlikely an out-of-court restructuring. Okay, so let's talk about the in-court restructuring. In an in-court setting, the bankruptcy typically begins when the petition is filed by the debtor, and this petition is called a voluntary petition. It is possible the creditors could file a non-voluntary petition. In other words, you basically miss a payment as the debtor, and the creditor could basically take you to bankruptcy. But the reality is, since being the filer, being the party that actually files, provides certain advantages, like selecting which jurisdiction you want to operate in. For example, debtors very much prefer to operate in New York and Delaware as opposed to other jurisdictions that are sort of less debtor friendly. And so the debtor almost always ends up filing preemptively when confronted with the possibility of bankruptcy, just so they retain some of those privileges. The petition will seek protection under Chapter 7 or Chapter 11. Chapter 7 is when a liquidation is contemplated, and Chapter 11 is when a company wants to actually reemerge from bankruptcy as a viable entity. Now, in most circumstances, recoveries in aggregate are higher under Chapter 11 than Chapter 7, because when you're talking about Chapter 7, you're talking about a liquidation, you're talking about having to offer fire sale discounts, and Chapter 11 is thus preferred by the debtor and most creditors, because if you do an organized restructuring that's successful, you're going to end up with higher recoveries than you would under a fire sale type Chapter 7 liquidation. There is an exception to that. There's an exception to everything in bankruptcy, And that's, when there are secured creditors who expect to receive 100% recovery, while sort of the lower tier creditors would expect to see partial recoveries. In situations like that, which are not that uncommon, where you have this sort of secured tranche, which is very comfortable that they're going to make out just fine, while you have these sort of lower tranches vying for optimal recovery. In those scenarios, the secured folks may actually prefer liquidation because it's faster. They still get the full recovery, but everyone else loses. And obviously there's some protections in the bankruptcy court to prevent secured creditors from basically bullying a company into liquidation. The timing of petition is important when you actually file, because it creates a clear line of what's happened before the petition date or pre-petition and what happened after the petition date or post-petition. Liabilities that are incurred prior to the petition date are subject to compromise. In other words, those liabilities that happen before you file for bankruptcy, all those liabilities basically get in line. Whether you are a vendor and you shipped off some stuff to a debtor and now the debtor owes you money and you haven't received it, or whether you're a lender, or whether you're an employee who needs a salary, those all represent liabilities for the debtor. And if those liabilities were created before the company filed for bankruptcy, those are all subject to compromise. You may not get full recovery, and depending on sort of where you are in the priority scale, which we'll talk about in great detail, that'll determine what your recovery is. But all the post-petition liabilities, anything that's generated after you file for bankruptcy, after a company files for bankruptcy, those receive priority treatment over all the pre-petition liabilities. So an example that Stephen Moy provides in his fantastic book is, if someone walks into the example is if someone walks into a store and slips on a banana peel, and he does it the day before the company filed for bankruptcy, they would make much less money on the lawsuit than if they slipped on that banana peel the day after the company filed for bankruptcy. Because the day after you file for bankruptcy, you, as the person who slipped on the banana peel, get priority treatment. Your claim is a priority claim over all pre-petition claims. Another concept that we'll be talking about throughout the course is the concept of the automatic stay. This prevents creditors from collecting pre-petition claims without the approval of court. So basically, one of the reason why they call it bankruptcy protection is because it essentially protects the debtor from the creditors who are trying to collect their pre-petition claims. Now the court has to approve any claim, any payment to claims. Financing may now become available to the debtor via what's called DIP financing, debtor in possession financing, despite pre-petition limitations. So whereas before you file for bankruptcy, you try to borrow money from a lender, they'll laugh at you because they're going to say, well, you're not even paying your existing lenders. Why would we want to give you any money? Well, financing becomes available through the bankruptcy process because there's an institutionalized priority scheme given to folks who provide financing post-petition. So DIP lenders often get super priority status via what are called priming liens, basically liens that prime over any existing secured claims. And that obviously is an incentive to lend to a company that's in the process of restructuring. Of course, the judge will approve this despite, of course, this creates a potential detriment to the pre-petition secured lenders, but the judge will approve this as long as the judge feels that there is adequate collateral to provide what's called adequate protection to the pre-petition lenders. Now, this whole idea of adequate protection, which again we'll talk about a little bit, is an art. It's not a science. And so the pre-petition lenders are almost always upset about the idea of being primed by DIP lenders, unless they themselves participate in the DIP, which does happen, which we'll talk about in great detail. But again, the key here to understand is that restructuring bankruptcy is not as much a science as it is an art. So many pre-petition lenders in this scenario will vie to become DIP lenders, for example, to mitigate the deterioration of their claim priority as it's being primed by these DIP lenders. Since the debtor will typically know that it will eventually have to file, it'll manage the timing so that cash can be conserved before the filing to give debtor maximum flexibility. So often what that means is that you actually see a company's cash balances dramatically improve before they file for bankruptcy because they know that they can basically blow, you can blow off paying, or I should say you can delay paying anyone that's pre-petition, but once it's post-petition, any claims that are generated post-petition become priority and you have to pay them immediately. So you're going to time it so that you basically delay payments to vendors, right? So then you have this large accounts payable balances. You file for bankruptcy, you don't have to pay them. Drawing, or you don't have to pay them until the court approves some sort of recovery to everybody. Drawing the maximum available revolving credit line, which revolving credit lenders absolutely love, right? That's a joke. They hate that. But right before you file for bankruptcy, you go and draw as far down as you can on the revolver, so you can get all this cash, and then these revolving credit folks have to get in line just like everybody else to claim to get their claim. And filing right before a large required principal payment to a creditor or a large interest payment to a creditor. Those are all things that may also sort of intimate when a filing will happen. If you know that there's a big payment due, that may be an indication that the company, if a bankruptcy is imminent, they may file directly before such a payment. So barring fraud or gross mismanagement, believe it or not, management will typically stay in place post-petition and manage the operations day to day alongside a turnaround consultant that will be brought in to support management. So even though management is the one that's often accused of being the ones who put the company into the mess that it's in, they actually quite often stay on board. Again, barring fraud, or sort of major mismanagement. Enron is an example where, of course, they got rid of the entire management. So another thing to sort of understand that throughout this process, while management's fiduciary responsibility prior to bankruptcy for a company that's operating normally is to the equity owners, it's to the owners of the business, it actually shifts to creditors, to all providers of credit, all providers of capital in a business, and that actually happens, when the company, according to the law, the responsibility should shift when the company begins to enter the zone of insolvency, which is, of course, difficult to pinpoint. But it's the idea that when the company believes that it may potentially be insolvent, that's when the fiduciary responsibility theoretically or legally should shift. Okay, in terms of the structure of an in-court restructuring, you have several committees that are set up to advocate for various claims. So the most notable one is the Official Committee of Unsecured Creditors. This committee is created in accordance with the Bankruptcy Code. It's designed to represent the interests of all unsecured creditors. These are creditors who do not have a lien or collateral securing their assets. Now, of course, for a company of any significant size, the diversity, these claims are diverse. They have potentially conflicting interests. Some unsecured folks may think they should get priority over other unsecured folks. So, of course, the diversity of this group can create conflicts, and that problem will be discussed in a little bit. Barring that issue, legal and administrative costs for this committee are actually charged to the debtor. This is perhaps a little more granular than we necessarily need to get into right now, but it is comprised of the 7 largest willing creditors. But the trustee that oversees the bankruptcy has discretion to create multiple committees. Again, this is to address this first bullet here, and change the size of the group when it believes the conflicting conflicts warrant it, when conflicting interests warrant it, despite the higher administrative costs borne by the estate as a result. Secured creditors are grouped by classes according to the collateral by which their claim is secured. And when you're talking about a syndicated offering, when you have multiple banks offering the secured loan, the agent bank represents the entire bank group. And shareholders typically get nothing unless there's sufficient asset value for all creditors to get paid, and then for equity folks to get a little something as well, in which case there will be a committee formed to represent their interests. Now, once a debtor files for bankruptcy, the goal is to emerge from bankruptcy via the adoption of what's called a plan of reorganization. The plan of reorganization is a document that identifies what will happen to the debtor's assets, liabilities, and equity upon exit from bankruptcy. So all this discussion that we've had about the exchange, who will get what, whether they're going to get cash or equity or debt, all of those issues and are identified in the plan of reorganization. Many pre-petition and post-petition events can essentially be viewed as strategic jockeying by competing interests to maximize outcomes that are going to be expressed in the plan of reorganization. The proponent of the plan, this is typically the debtor, which is granted the exclusive right to present the plan within 120 days of filing. So usually this is one of the privileges of being the party that files. You get to get exclusivity. You're the only one who can present the plan, suggesting exchanges, suggesting who should get what, etc. And so the proponent of the plan, typically the debtor, prepares a disclosure statement to solicit creditor acceptance of the plan containing information about the debt and the effect of the plan. And opponents at that point, of course, can also solicit rejections. Now, the exclusivity period is often extended by the judge beyond 120 days, but after this period, creditors may also propose plans. Okay? Sometimes the debtor and creditor negotiate a plan prior to bankruptcy. We talked about that a little bit before, and they vote on it immediately upon filing as a way to accelerate the process when there's substantial cooperation between parties, and that's called a pre-pack or a pre-packaged bankruptcy. And that dramatically reduces the duration of the bankruptcy process. You may even have bankruptcies that take less than 45 days if everything was essentially negotiated ahead of time. Obviously the benefit of this is that it dramatically cuts down on legal costs and other costs. If the plan is accepted, and acceptance is a function of complicated voting rules, which we'll spell out in a little bit, and meets criteria and tests of fairness set by the court, the plan will be confirmed by the court and the company will emerge from bankruptcy with new contracts, fewer liabilities, and a new capital structure. Presumably, the company will be a company that is viable and can operate going forward. Over the last several years, there's been a trend toward faster workouts. Legal fees are pretty significant in bankruptcies. Here we've got some examples of prepackaged bankruptcies, some high-profile prepackaged bankruptcies. And now let's talk about really the plan of reorganization, the structure of it. And there's two substantive parts of the plan of reorganization. One is who are the various claims. And grouping claims is actually very important because there's sort of this priority hierarchy. And you have to take care to classify based on commonality of interest. And the classes are actually comprised of claims that are similar in terms of priority, meaning unsecured bank debt, bonds, tort claims are all unsecured and of similar priority, so they can be grouped in the same class, for example. Secured classes, on the other hand, are grouped based on collateral interest and lien priority. A couple of nuances here, by the way. If the collateral value is less than the claim is actually bifurcated. It's the portion that isn't secured is now considered an unsecured claim. The second part of the plan of reorganization is what each class will receive. Will they receive a new debt instrument? Will they receive equity or cash? So let's go back to our example, and that'll help put all of this into perspective. In our example, we determined that the lenders will exchange their $700,000 in claims for $100,000 in new debt and 100% of equity in the new firm. So, actually one thing that I think is worth mentioning here is in an out-of-court restructuring, notice that we couldn't give the lenders 100% equity. Let's just go back here and refresh our memories. In our scenario, we had to basically dilute the old equity owners by issuing tons and tons of new shares. But you couldn't actually just get rid of the old equity. And that's because in a voluntary out-of-court restructuring, you don't have the legal right to take away someone's equity, stock certificate. But in an in-court, let's go back to the in-court scenario we just talked about. In an in-court scenario, you don't have to worry about that. If the old equity folks are out of the money, in other words, there's no sufficient asset value to give them any money, the bankruptcy court has large discretion to basically say these guys get nothing. And so let's talk about in our example, we've determined that the lenders will exchange their $700,000 in claims for $100,000 in new debt and 100% of the equity in the new firm. So the old equity folks get nothing in the in-court scenario. And the value of the assets, if you recall, were estimated as $290,000. Factoring in legal, accounting, advisory fees, and DIP financing, we'll talk about that in a moment, a hypothetical plan of reorganization for our example could look like this. You have a $1 million claim on, or I should say, sorry, we're in 1,000 denominations here. So let's say you have a $1,000 claim for legal fees, and those get paid out first. They get what's called administrative priority. Actually, we get a little footnote here that identifies that technically secured claims are ahead of administrative claims, but there are carve-outs by lenders that allow certain administrative claims to actually be paid out before the secured claims. So this is sort of more practically what you see, although we just want to make sure everyone's aware that sort of technical reality, that nobody can be in front of secured claims unless the secured claims agree. So you have the professional fees right up here, and so let's say it costs us $1,000. We have to hire a very cheap lawyer and only paid him $1,000 to help us with this bankruptcy, and so that's the first claim, and the payout is going to be in the form of cash. So remember, we have $200,000 in cash. This is going to be part of it. But also during the bankruptcy process, we secured a $3,000 debtor in possession financing post petition, and the moment that we emerged from bankruptcy, remember we originally secured it the day we filed for bankruptcy, and now several months have passed, and there's only $2,000 outstanding on this loan. The DIP, which gets a super priority secured claim, will be paid in full in cash as well, so they're paid out fully. And now we have our 500,000 secured claims. They are given priority in administrative claims. So given the priority in administrative claims of a total of $3,000, there's only $287,000 in value. Remember, this business has an estimated value of $290,000. There's only $287,000 worth of value left. So this is the most that they theoretically could get. And let's say the very unrealistic scenario that these unsecured claims just roll over and say nothing and don't argue about this, these guys would get everything. So the pre-petition secured lenders would receive $100,000 in new notes and 100% of the equity in the new firm. Since the assets are $287,000, this is the value that they get. The value of the equity is, by implication, $187,000. We're implying that this business has a value of $187,000. Now, the reason theoretically this is sort of a waterfall. We're basically saying, okay, well, there's $290,000 of value. These guys got one. These guys get two. And since these guys have this, priority claim over these guys, they get everything else. Meaning that these the unsecured folks with 200,000 in claims get nothing, and of course the old equity get nothing. That's the most plain vanilla, simplistic plan of reorganization you're ever going to see. We're going to talk very shortly about what these guys may say to object to such a thing. But for now, let's keep going with it. So at this point, we've laid out the plan of reorganization, who gets what, and we need to start thinking about this number. We know what we got to 290,000 as the value of the assets of this company by looking at what the market was saying about essentially the trading levels of debt, right? And the fact that equity is basically trading at zero. But the question is, when we're thinking about this asset value, that's one way to look at what the value of the assets are. Estimating recoveries really depends on the player's assessments of the true value of the asset pie. Now, we know that GAAP doesn't accurately measure the true market value of assets and liabilities, but the estimation and valuation of assets and liabilities is a critical and contentious part of the process. So we want to make sure we understand how assets are valued. So we know there are some traditional methodologies for valuing businesses. We have the discounted cash flow analysis. We have, looking at comparable companies using multiples, liquidation analysis. They all provide various estimates for what the value of the company's assets may be. There are also other considerations in a bankruptcy. We'll talk about them real briefly here, and then we'll talk about them in more detail later on. and that's that assets, the size of the assets that you have may actually be less, it may appear first to be less than they really are, because in a bankruptcy you may have situations where you had made in the in the past payouts to certain folks, you maybe issued dividends, or you had given money, you had basically paid out a lender, say 6 months ago or whatever, where you might be able to claw some of those payments back. There's a concept called avoidable preference, a concept which is related, called a fraudulent conveyance, and both essentially say that, hey, if you, as the debtor, as the company that's now bankrupt, made payments in the past over the last 2 years, or over the last year, depending on or over the last 90 days, depending on the specific scenario, if you made payments to folks that were, given the fact that you're actually bankrupt, in hindsight fraudulent or voidable, well, we can claw that money back and bring it back into the estate, meaning that the value of meaning that the pie is actually bigger than we may have originally thought. On the liability side, we know that we have all these liabilities that we talked about: administrative claims to professional fees. We have to pay the DIP lenders, we have to pay secured and unsecured creditors. But the size of the liabilities, part of what's attractive about filing for bankruptcy, is that you may actually shed some liabilities as part of the bankruptcy process. You may be able to get rid of executory contracts, things like unexpired leases. That a company like Borders, which we'll talk about in great detail, they have a lot of unfavorable leases. They thought they would open stores in just about every strip mall in America, and it turns out that a lot of these leases that they sign into 30-year leases, and these stores are not doing well. But they can't get out of these leases outside of the context of bankruptcy. And so getting out of these long-term contracts is really a privilege that exists only in the context of bankruptcy. Other things like long-term contracts like retiree benefits, collective bargaining agreements can also be rejected. There is a higher standard for these types of contracts and leases, but the bankruptcy code provides some clear rules for how you can limit or just get rid outright of some of these contracts, which means your liabilities are lower than you may have originally thought. In our example, we didn't identify any of these types of liabilities, but of course, you can imagine for many companies, these are liabilities, and the smaller those are, the less folks you have to pay. Okay, so with that, we can talk in really broad strokes about valuation. We talked about some of the considerations, and valuation is just such a critical part of restructuring, and I think this slide here really represents why. Let's revisit the example that we just talked about. Once again, assuming you have two creditor classes, the valuation methodologies employed by financial advisors and valuation experts can and do dramatically yield different results with significant implications to various creditor classes. So recall that the valuation for the company's assets was $290,000. Now we know, presumably we were able to arrive at that by looking at how the market was at that particular day was valuing the debt. But when you get in front of the bankruptcy court, what you're going to provide as justification for why you think your business has a value of $290,000 is going to be, certainly part of it is going to be market trading levels, but another element of it is going to be, well, what's the discounted cash flow analysis potentially say for this business? What do comps say for this business? And so let's say we came in, we said 290,000 was one opinion, but what if another opinion came in from, say, another creditor that the business is actually worth 600,000? They ran, and those of you who have an investment banking background know that you can essentially make your DCF say you can make your DCF based on the assumptions you put into it very widely in terms of the values that are derived by it. So what if another valuation opinion arrived by, say, the subordinated lender that suggests a value of $600,000? How does that affect everything? And before you really answer that question, let's think more broadly. Which valuation do you think the senior lender would prefer? A very high valuation of $600,000 or a very low valuation of $290,000? What about the subordinated lender? Which would they prefer? Remember, you have a subordinated lender with a contractual, um, you have a subordinated lender that's lent out 200,000, senior lender lent out 500,000. Which valuation would each one prefer? Well, at the low valuation of assets, the senior lender is not made whole, right? The senior lender is not made whole, and that's the scenario that we had been talking about. And under the absolute priority rule, the absolute priority rule in bankruptcy is what we've implicitly been talking about up till now when we talked about sort of the priority of claims. The absolute priority rule basically says priority claims that have priority over other claims, must be paid in full before lower claims can be considered. So, assuming, again, capital structure is $100,000 new debt, $190,000 new equity, the senior lender would have to receive 100% of the new equity because they're still not going to be made full. They're still underwater. So under the absolute priority rule, they have to get all that value. But what if the valuation was $600,000? It's a different story at that point. If the valuation is $600,000 and the judge buys into the idea that the value of this business is not $290 but $600, and assuming a capital structure of $100,000 in debt, in other words, the debtor is willing to take on just that same $100,000 in debt that they were willing to a moment ago when the valuation was supposedly $290. Well, that means there's $500,000 in equity value left to distribute. And so the recovery would look as follows. The senior debt would receive $100,000 in debt and $400,000 of the new equity. That makes them whole. That gives them $500,000 in value. But now you have $100,000 in equity value that still can be distributed to the sub, which now gets 50% presumably recovery. So clearly the sub prefers the higher valuation in this example because it gives them some of the equity. Now the senior would get all the equity under the low valuation because they hoard a higher share of the recovery. And what I think is probably the most critical part of understanding this is that the valuation is a function of expectations of the future, which is subjective. For example, if the lower valuation prevailed, in other words, if the judge sort of bought into the idea that it's $290,000 and gave all of the equity to the senior folks, but the company was then, subsequently sold post-petition to somebody else, a third party, for $600,000, which of course implies that the valuation was $600,000, not $290, because someone was willing to pay $600 for it. That $600 valuation is probably more accurate. Well, the subordinated lender has no recourse. They just got screwed. I mean, essentially, the subordinated lender didn't make an aggressive enough argument, and they didn't get any of the equity because the judge said, hey, this is only $290, and the senior folks are underwater, so you shouldn't get anything as a subordinated. So since the implication to recoveries is anything but theoretical, basically whatever the valuation input is, that has a very real bearing on how much equity the various creditor claims are going to get. The valuation in a bankruptcy becomes so important. It's a critical part of the bankruptcy story.